All right, let's get right into it. A sudden policy shock just sent a massive tremor through the entire global financial system. But here's the thing. According to the latest IMF report, that shock didn't really cause the damage. Nope, it just exposed the deep, dangerous cracks that were already there, leaving the whole structure teetering on the edge.
So here's our game plan. First, we're going to look at that initial tremor. Then, we'll dive into the pre-existing cracks it ripped open. We'll explore the huge contagion risk from hidden leverage and see how all this is squeezing governments and major companies. And most importantly, we'll connect the dots to what it means for you. And finally, look at the proposed path back to some kind of stability.
Okay, so this whole thing really kicked off with just a single policy shift. It wasn't some random earthquake. It was the one specific catalyst that brought years of simmering, hidden risks right to a boiling point. And the market's reaction? It was instant, and it was global.
The date to remember is April 2nd, 2025. A surprise announcement about new tariffs completely sent markets into a tailspin. And as the IMF puts it here, everything went haywire at once. Stocks got incredibly volatile, and you saw corporate bond spreads widen, which is just a fancy way of saying the market suddenly thought a lot more companies were about to default on their debt. It was a massive, simultaneous shockwave.
This timeline really shows you just how fast things went off the rails. You can see the IMF was already waving a red flag back in October. A few tariffs started in February, but that April 2nd announcement, that was the real explosion. And even though they walked some of it back a week later, it didn't matter. The damage was done, the uncertainty was baked in.
And this is where you can really see the impact in black and white. The IMF has this model, growth at risk, which basically maps out a plausible worst-case scenario. In just 6 short months, that worst-case forecast for global growth absolutely collapsed, from a kind of weak 1.2% down to a barely there 0.4%. To put it simply, the risk of a really bad global downturn pretty much tripled overnight.
So why was that shock so powerful? Well, because it didn't hit a strong, healthy system. It slammed into a system that was already incredibly fragile. Let's peel back that layer and look at the underlying weaknesses, those pre-existing cracks in the foundation.
The IMF basically points to 3 big cracks that were there long before this recent turmoil. First, you had stretched asset prices. Stocks and bonds were just priced for perfection, historically super high. Second, you had this buildup of leverage, or debt, in the non-bank financial world. And third, holding it all up, you had governments around the world already drowning in debt.
Let's just take that first crack, those stretched prices. Even after this recent panic and sell-off, U.S. stock valuations are still in the 80th percentile, historically speaking. What that really means is that prices seem pretty disconnected from the actual economic reality, which kind of hints that more painful corrections could be coming. Now we get to the really scary part, the multiplier effect. This is where everything gets tangled together, because to understand how a small problem can become a huge one, we have to look inside the massive and often pretty opaque world of non-bank finance. So first things first, let's get a key term straight that you're hearing a lot about. Non-bank financial intermediaries, or NBFIs for short. What in the world are they?
You can think of them as the shadow banking system, though that term sounds a little sinister. Really, we're talking about places like hedge funds, private credit funds, and even mutual funds. They do a lot of the same things banks do. They move trillions of dollars around the economy, but they do it without a full banking license, which means they operate outside of those really strict banking rules.
And their role is getting bigger. I mean, just look at this chart. These investment funds, a huge slice of the NBFI world, are just taking up more and more of the total financial pie, often growing at the expense of the traditional banks we all know. And here's the absolute kicker. This isn't some separate system operating in a vacuum. It's deeply woven into traditional banking. Now look at this chart showing the trend. But listen to this number. U.S. banks' total loans and commitments to these NBFIs have exploded to a level equal to 120% of the bank's own capital cushions. The two systems are completely tied at the hip. This crazy level of interconnectedness is what creates the perfect storm for a deleveraging spiral. It's a vicious cycle. An NBFI with a lot of debt takes a loss, so it's forced to sell assets to raise cash. That selling pushes prices down for everyone, which causes more losses and forces other players to sell too. It's a horrifying domino effect that can turn a small shock into a full-blown market meltdown. Okay, so this stress isn't just some abstract problem for Wall Street traders.
It's putting real, tangible pressure on the governments that run our countries and the corporations that employ millions of us and power our economies.
And nobody's immune here, but the pain just looks different depending on where you are. In advanced economies, governments are running bigger deficits and are going to have to sell a ton of new bonds to cover them. Meanwhile, emerging markets are getting absolutely hammered, with the highest real borrowing costs in a decade. They're forced to take on incredibly expensive debt just to keep the lights on.
And for companies, there's a massive bill coming due. Just look at this table. Corporations borrowed tons of money when it was cheap a few years ago. Now all that debt is maturing, and they have to refinance it at today's much higher rates. You know, paying 5% instead of 3.5% might not sound like a disaster, but when you're talking about billions of dollars, that's a gigantic new cost that's going to eat directly into profits.
So let's bring this all home. How does all this chaos in the financial markets actually trickle down and affect you? Well, the IMF report shows these risks ripple directly into our personal finances, mostly through two big channels: our investments and the housing market.
The thing is, in recent years, regular households have become way more exposed to the ups and downs of the stock market. Take the US, for example. Stocks now make up about 35% of all household financial assets. Now that feels amazing on the way up, but it also means our collective household wealth is now far more vulnerable when markets take a dive.
And then you've got real estate, specifically commercial real estate. It's facing its own debt wall, a massive refinancing cliff. We're talking hundreds and hundreds of billions of dollars in mortgages coming due every single year, all of which now have to be refinanced in this new, super high-rate world.
And the pain is most acute in the office building sector. I mean, with remote work and everything, these properties have been hit so hard. And this number is just staggering. In 2024, less than a third, only 32% of maturing loans on U.S. office buildings were actually able to be successfully refinanced. That's a sign of extreme 5-alarm fire levels of distress.
So, after all that doom and gloom, you have to ask, what's the way out? Is there a path through this? Well, the IMF doesn't just ring the alarm bell and run away. It also lays out a pretty clear policy playbook for governments and regulators to try and navigate this mess.
The playbook really has four main parts. First, central banks have to be ready to pump in emergency cash and intervene early if markets freeze up. Second, regulators need to get serious about strengthening the rules for everybody. That means finally getting the Basel III banking standards fully in place and getting a much better grip on all those NBFI risks. Third, governments have to stop spending like there's no tomorrow and rebuild their financial cushions. And finally, none of this works unless there's better global coordination.
And this all brings us to one last crucial question. This whole episode shows how a single, isolated shock can send a tsunami racing through a deeply interconnected global system. So it really leaves us wondering, in a world where money and risk flow so freely across borders, can we ever actually build a financial system that's truly resilient? Or are we just destined to lurch from one crisis to the next? That's the big question to think about.